What's going on, everyone? Welcome to this week's real estate market review. We have a lot to cover today. We are going to talk about affordability. We're going to talk about the home ownership rate. We're going to talk about whether or not the Fed lowered or raised interest rates. We're going to give you an update on mortgages, not only where the rates are, but also the volume of applications. And then we're going to talk about forbearance as well. Welcome to Macro Thinker. If you are new to the channel, please consider smashing that like button to help push this content out to more people, and tap that subscribe button to see more weekly videos on finance, real estate, and investing. My name is Lewis. Let's get it. All right, so we're going to go ahead and jump right into it. Up on the screen, I have a chart from the St. Louis Fed for the home ownership rate in the United States. This chart dates back to about 1960, and you can see the different peaks and valleys where home ownership rate was higher and then where it was lower. And what I want to kind of point out here is that, let's say the home ownership rate peaked in 1980 at about 65.8%. That's an indication that maybe real estate was a little cheaper then, and lots more people were purchasing, and or there were more loan products available for people to secure financing. Well, as we look further into the future here, you can see that the homeownership rate actually went down into the late 80s and early 90s, sitting somewhere around 63.7%. From there, we saw home ownership grow and reach another peak in 2004 and 2005, nearing an all-time high of about 69.2%. Now, a lot of you know what took place in 2007, 2008, and forward, and that's to say, I'm talking about the great financial crisis where things got extremely expensive and there was lots of subprime loans and risky financing. Well, homeownership, even though it reached an all-time high, you can see that after the peak in 05, 06, the home ownership rate went down significantly to almost an all-time low in 2016, sitting about 62%. Since then, that rate has actually increased. We saw a peak in the home ownership rate again in the second quarter of 2020, bringing that rate back up to about 67.9%. And post-pandemic, that homeownership rate is actually pulled back a little bit. We are now in the first quarter of 2021 sitting at about 65.6%. And I'm not too surprised to see the homeownership rate decrease at this point. One of the reasons is that home prices have increased substantially, and it's contributing to affordability. And at this point, homes are becoming less and less affordable despite what the interest rates are doing. So now up on the screen, I have an article from Mortgage News Daily to support the home ownership rate being pulled down slightly. But there's just a few things that I want to point out here. It says that home ownership was the highest in the Midwest at 70.3%. followed by the South at 67.4%, Northeast at 63.1%, and then the home ownership rate was lowest in the West at 59.7%. Among the various age groups, those that are under the age of 35 had the lowest rate at 38.1%, followed by those between the ages of 35 and 44. They contributed about 62%. And the highest rate, as usual, is the oldest age group. Those that are ages 65 and over, they made up about 79.3% of that group. Now, switching gears slightly, I have another article from Mortgage News Daily, and it says, no, the Fed didn't do anything to mortgage rates today. It's interesting to see this article because the Fed doesn't control rates directly. When they talk about raising or lowering rates, they are actually talking about changing what is known as the federal funds rate. That is a target rate for overnight lending between big banks. Mortgage rates can loosely correlate with the Fed funds rate over very long time horizons, but they frequently move in opposite directions. More importantly, mortgage rates are constantly moving, whereas the Fed funds rate hasn't changed in more than a year now. So why do mortgage rates have a history of big reactions to the Fed if the Fed funds rate doesn't have much of a bearing on mortgage rates? Well, simply put, the Fed does other stuff besides announce the Fed funds rate. That's just a piece of the announcement that news outlets tend to lead with. Mortgage rates are far more interested in the Fed's bond buying programs, which include $40 billion per month in new mortgage bond purchases, in addition to reinvestments of proceeds from past mortgage bond purchases. On that topic, the Fed held steady and indicated we're still a long way from a situation where bond purchases would be tapered. So what's basically going on is the Federal Reserve has a purchase program in place to buy $40 billion worth of mortgage-backed securities each and every single month. Now, if they continue to purchase these bonds, there is a high probability that mortgage rates will stay low. So a lot of people really follow what the Fed is doing, and if they indicate they're still going to be keeping interest rates low and they're still going to be buying these mortgage bonds, then it's a good indication that we're going to see interest rates stay low for an extended period of time. On that note, let's take a look at the 10-year Treasury yield. Currently sitting at about 1.626%. It is stable, not much change over last week. And then if we're looking at mortgage interest rates, they've actually ticked up a tad this week. 30-year fixed is hovering at about 3%. Depending on how you qualify, I've seen 30-year fixed rates anywhere from 2.875 to 3.25%, depending on the fee structure. 15-year is sitting at about 2.3%, and the same goes for the 15-year. I've seen anything from maybe 2.25 to 2.5, depending on how you qualify, and then the fee structure there as well. So mortgage applications are now down slightly. We decreased about 2.5% from 1 week earlier, according to the Mortgage Bankers Association. Mortgage applications decreased last week, even as mortgage rates dropped for the third week in a row. 30-year fixed rate was down 3 basis points to 3.17%, which is still 32 basis points higher than the low reported in December of 2020. Even with a few weeks of lower rates, most borrowers have likely already refinanced, which is why activity has decreased in 7 of the last 8 weeks. And this was said by Joel Kahn, the Mortgage Banker Association Vice President of Economic and Industry Forecasting. The purchase market's recent slide comes despite a strengthening economy and labor market. Activity is still above the levels it was a year ago, but accelerating home price growth and low inventory has led to a decline in purchase applications in 4 of the last 5 weeks. So what Joel is basically saying is that purchase activity has gone down slightly because we don't have as many homes for sale and the prices have really elevated. In addition to that, even though interest rates are lower than they were a few months ago, the refinance activity is down because a lot of those who wanted to refinance, they already took care of that in 2020. And then the last thing that I want to touch on is the forbearances. So the share of mortgage forbearance actually decreased slightly to 4.49%. Now, this is a good indication that things are getting slightly better. The article says, after 2 weeks of large declines, the share of loans in forbearance decreased for the 8th straight week, but by only 1 basis point. New forbearance requests have actually increased, and the rate of exits declined. And this is said by Mike Frantantoni, the Mortgage Banker Association Senior Vice President and Chief Economist. More than 40% of borrowers in forbearance extensions have now exceeded the 12-month mark. This is one of the things that we want to pay close attention to because this is most likely contributing to the low supply of housing inventory that we currently have on the market. Once these forbearance periods end, it's possible that we may see more inventory start coming online. Another thing I wanted to point out that I thought was pretty interesting is it breaks down by percentage the different types of borrowers who were impacted here. So of the cumulative forbearance exits for the period from June 1st of 2020 to April 18th of 2021, it says that 26.9% resulted in a loan deferral or partial claim. 25.4% represented borrowers who continued to make their monthly payments during the forbearance period. So that's interesting. Basically, a little over 25% of people that took forbearance are actually continuing to make their payments business as usual. 14.6% represented borrowers who did not make all of their monthly payments and exited forbearance without a loss mitigation plan in place. 14.4% resulted in reinstatements, in which past due payments are paid back when exiting forbearance. That's a higher percentage than I would have thought, because if you're delinquent, let's say $10,000 in payments, you have to pay that full chunk at one time. 9.6 resulted in loan modification or trial loan modification. 7.5 resulted in loans paid off through either refinance or by selling the home. I would say on this particular one, it's more likely that those borrowers were selling their homes, because if they were in a forbearance plan, it'd be very difficult to get a refinance completed if you don't have at least a 3 to 6 month payment history. The remaining 1.6% resulted in repayment plans, short sales, deed in lieu of foreclosure, or other reasons. All right, so there you have it. The homeownership rate is going down slightly. The Fed has committed to keep the rates at 0 or 0.25%. They have committed to continuing to buy $40 billion worth of mortgage bonds, which will keep rates low. 30-year fixed mortgage rate is sitting at about 3%. 10-year bond is stable. We have seen the mortgage application volume decrease slightly, and we've started to see the amount of loans in forbearance decrease very slightly. Inventory is still very low, which is pushing up prices. It is contributing to the lack of affordability. This market is still red hot. It is on fire. We're going to continue to monitor this market and keep you informed, and we will see how this unfolds. All right, that is going to do it for today. Thank you so much for taking the time to watch this video. If you haven't done so already, please consider smashing that like button. When you smash the like button, it tells YouTube to share the content with more people. And please consider tapping that subscribe button to see more weekly videos on finance, real estate, and investing. Thank you again. Take care.